That's key, isn't it? There was so much vaccine optimism going into the end of the year. The actual translation into getting, jabs into arms has widely been pretty slow and incremental, and some would say disappointing so far. Does that make you more inclined to try and have a well-balanced, how much rebalancing are you doing with your portfolios at the moment compared to last year?
Well, we are actually positive for the outlook of 2021. The stock markets may not do as well as they did in 2020. 2020 was a very good year for the stock markets, despite the economic misery, unfortunately. But I think 2021 looks positive. Yes, getting the vaccines off the ground, making sure that people are vaccinated is proving to be a challenge. The companies have a tough time increasing production. There are hiccups along the way. I think that's to be expected. The markets will, be volatile partly because of that. But we're not concerned about what's happening in the short term. We think that, in the next 12 months, 18 months, as more vaccines become available, as more people become vaccinated, as lockdowns start to ease, as economic activity picks up, as fiscal stimulus, comes on in a bigger way after Biden takes office, I think all those put together will augur well for, the global economic recovery, as well as, further upside for the stock market. So yes, in the short term, there are a few hiccups, bumps and bruises here and there. But I think if you take a medium-term view of perhaps 12 to 18 months, there are reasons to be optimistic.
Where do you find value when valuations are where they're at? Do you take a look at the Nikkei in dollar terms? It's at a record, not to mention, just the fast and furious rally we've seen when it comes to Korean stocks as well. Where do you find opportunity?
Well, if you look at the valuations, yes, if you look at the price to earnings ratio, yes, it seems high. The MSCI, world index is trading at almost 2.5 times P ratio relative, 2.5 standard deviations above the 5-year average. And that seems a bit high. But bear in mind that interest rates are very, very low. Our view is that interest rates are going to stay low for a long period of time, perhaps even the next 3 to 5 years. And given that sort of backdrop, there is room for valuations to increase even further. So yes, tech stocks have been the main driver, but we think that the baton will be slowly passed on to the cyclical stocks, the value stocks. And there's still value in that segment because that segment of the market is not done as well. Because if you look at the MSCI growth index, that has gone up 33% in the last year or so, whereas the MSCI value index has been largely flatlined to down 1%. So it's underperformed growth, or in other words, technology. And I think, the cyclical stocks, the recovery stocks, the banks, the real estate, the energy, the industrials, this could still play catch up because they've underperformed. The stretch valuations are partly coming from technology, but the non-tech stocks are not as expensive.